a second here. And we're live. Cool. 1 second. And yeah, so this session, once again, is just live New York session. I'm only trading GU. And currently, after the inflation, the CPI reports, even though inflation is slowing down, it's slowing down rapidly, and it passed the forecast. That's why the currency on the on the United States dollar has been decreasing, and that's why there's this big move here, um, quite a big move, honestly. See how much that is, 120, 130 pip move. And you count all the way up here, and it's at 160 pips. But I don't care much about the pips. Uh-huh. Cool. So yeah, with that said, I'm still just waiting for this. Let's quickly do a recap here. Let's mark up the 15 minutes because it's just formed. That's at 30. It's a little bit laggy because I'm running a lot of applications at the same time. I have the FDMO terminal up. I got OBS, I got Chrome, and I got TradingView. So quite a bit. Cool. And my stream says no data, but whatever. But yeah, essentially after that push up, we just want to look for 15 minutes OB to kind of anchor price down after it formed over here, since I can see. After it formed to the left, um, price kind of come down and broke through that, so now it comes back up once again. I'm looking at I'm looking at a sell opportunity when price come back up to the Fibonacci optimal level, which is around here now. Because this is a counter trend and it is extreme counter trend, I would wait for a clear transition, in which case we have broken through the previous short-term lows on the 5 minutes, and like I said, on the 15 minutes as well. 30 minutes is still like normal. There's nothing really going on over there, except for the fact that the wick has come back down and we wick through, and price have pushed up here once again. So we may see a reversal in the middle here. At the same time, you can look down. After that push, there are after that push, there's an inefficiency, a lot of inefficiency actually. So I want price to at least swallow up this big, 80 pips, and the void. In 1 minute, you can see here, it's pretty much the same thing. It's pretty much bigger. A little bit retracement up here, but essentially it's still big, about 50 pips or so. But yeah, it has broken through the short-term lows. No 5 minutes there, maybe 3. Yeah, maybe 3 minutes. But it matches up with the minus 27 anyways. So right now it's at the optimal yeah, around optimal entry. I'll wait for another candle to kind of form here. You see we can lower out down our stop loss and essentially reverse this price back down. This is a good zone. Sometimes things happens. I would say sometimes price does this. It just continue pushing down. Sometimes it goes up here, and then it formed this, and then a double top once again. We can sell in after price retrace back up. In which case I want to see a clear, good indication the price is in fact, um, taking this level as the anchor instead of just continue moving in that same direction. Because you can see on the left there is no structure at all. Price have we see a bit of selling pressure, but it does not form any black candles at all. In this candle right here, you can see that it is a hammer that indicates that buying pressure is coming into the market once again. So again, essentially, this is kind of like a not a great area to open a trade. So let's go ahead and see here if we that maintain that level. If we maintain this level here, then we may as well take a sell. See double top. See if we can maintain that level. 5 minutes. We have look like we are maintaining the level pretty well. So I'm gonna just take a sell here. Around, let's go 5 pips if it's possible. And we're in. Okay, cool. So we're in. Let's see, 65. We may have to. Yeah, this is a really risky level. Like I said again, it is a counter trend, so we want to see a good, clear transition. But now we're just doing a double top. Um, in this case, we may enter too early. With that said, yeah, let's just hang around and see how price is gonna go. If it doesn't go in the direction, then it should be fine. Yeah, it seems like we're losing selling pressure, a price pushing into the zone right now. As soon as it breaks through, I'm gonna just cancel out the trade. Yep, and it seems like it's not doing well. Price continue pushing up once again. So we have a loss right there. That's a 1% down for today. Price reach up to minus 79. It just so happened because we want to reduce our stop loss area. That's all it is. But now it has passed that level where we want to see an actual, like a clear area for price to just reside. Retracing past that point, we have a lot of buying pressure, still maintaining the price, still maintaining the level. cool. We see a graveyard. Still, still maintaining that buy side pressure. Yeah, so market condition is a little bit erratic. Seems like it's pushed through once again. But now we have a little bit of structure to base off of. That's a good rejection on the 3 minutes here. Excuse me. The previous short-term low has been wicked through. This one here is still lower, but I count this. And let's go ahead and draw our fib, smaller fib, but yeah, still want to be wait for price to go up there. Seems like we have a good area of dissension. Good touch on the 3. Wick through. Still a bit calm there. See here. Stop loss are really much bigger. cool. So I got a trade in the middle when prices, was dropping down. But yeah, essentially we still caught some of the trade, some of the move, I guess. Um, I was in the middle of it, so I didn't say anything. Yeah, essentially we still go out here to 103, and then we got out. And I just learned that on the FTMO terminal, of course, the spread and the spread and how the price actually move, the tick is actually a lot different than on TradingView. So not really that much different, but um, essentially the tick on two sides. One, of course, you need to calculate the spread as well. So the spread after a while, um, when I sell in, I think the spread was a little bit bigger. That's why it's not that great because it's trying to cover up the spread when you take profit. So even though we take profit on the charts, it matches. Price usually wants to go past that. Usually want to go past that before it can completely take profit. So essentially that's how it is. But yeah, we just got a 1-3 again. We lost our first trade, which is entering a little bit too early here onto the charts, entering a little bit too early. So right after that, I see this right here on the 15-minute. This is a doji indicating that price have been even out, and it's a significant point where both orders are, both sides, the bull and the bear, are kind of evening out, and there's a significant level for the winning direction because that is like a neutral point, right? That means that buying pressure has evened out and selling pressure has also evened out of the price. So that's why, in the winning direction, when it comes back down, the overall direction, when it comes back down to that level, it usually continues or it continues to reverse in like a big macro trend. So I see this on the 15-minute time frame, and I was like, okay, so there is a 15-minute doji here. That means that price is gonna continue pushing down, um, having little chance to push even higher because you know it try to retrace. It kind of want to retrace in that level. So we have the 1 minute doji over here as well. So that's like an interest zone for us to mark up our area. So essentially, you see a price here. It has broken the dynamic trend line. Isn't even though I don't really like the trend line as much. You can see here the 1 minute doji kind of form over there. So I guess the first trade here, the mistake that I made on the first trade is just to enter too early without any signs of a complete, penetration into 70.5. So I need to look for 70.5 as well. Around that level, this one is kind of it, but at the same time, it's still outside of that zone. Um, but yeah, essentially looking for an entry anywhere in between area here. Um, so if we're going to enter right up to the 5 minutes, that should work as well. 250, and then draw the Fibonacci from the all up to the high. It's a 19 pips, a little bit too big for me. Even too big for me for like a good risk reward ratio. Draw it down to minus 27, not even 1 or 3. So essentially, if you draw it and project it like that, 2, 3, so 14 pips, and of course matching up the Fibonacci. So that's a 1 or 3 in the middle, just like that, just like right there. So essentially, is around 70.5, is around that level where most people were going to enter in. Um, in like the intraday or day trading aspect of it. So this is where we would look for a good entry. I think that's like a mistake, or one thing I have missed. But at the same time, when price come back up here, is a double top, mini double top, anyways. Um, so that loss here is not really a mistake. I would say that's a lack of technicals analysis. I would say. You can see here 311 and coming back down. It's just a little bit. It still meets the 1 to 3. So essentially, you see people entering in here as well, but their stop loss is all the way up here. Um, that's why it's like it has a lot of space for the price to move. That's why people are not that worried. But we as scalpers, we are looking for a smaller stop loss. So I guess this one area here is a bad sign because we don't want to have that low of a stop loss in terms of price is forming some structure. So let me mark this up here as reference. Don't mm, hmm. Hold on 1 second. I was just checking out the thumbnail. Even I mark it up like that. So even now I projected the trade to go all the way up here to one of the significant levels. Confluence. 31 is like the perfect area. Still yields a 1 to 4. Up here still yields a 1 to 3. So that's the projected trade. So let me mark this. Let me save this as projected trade. Already got the trade for the day, so we're pretty much good on that end. So what I can say for this session, um, a lesson to come out of it is that I would rather entering in a position later other than entering earlier. Because essentially, if you enter earlier, you don't know where price is gonna reverse, and you're still giving them, an a good amount or a good like how you call it a good range for price, and it can still continue to retrace even higher. And if you keep entering, then you could be stopped out every single one here and there, here and there. Um, but if you enter later, what you can do is that you can widen your stop loss. Um, you can widen your stop loss and get some profit in the end. Get some profit and essentially take it along the way. So you don't want to enter in too late or too early. It's just around, just late, or just about there. So not too early, but not too late either. So wait for good signs and then just enter in when price have reached most of the criteria. So essentially here, price projected up. The potential risk reward ratio when it comes back down to minus 27 is a 1 to 7. That's like a 5 pip stop loss. 1 to 3 is just around there, in which case it's already pushed all the way through. Um, what else? When price come back here, it reached the projected trade where we initially wanted it to go to, and it reached that level. We can enter in right there, stop loss above, and 1 to 4, and then 1 to 3 right there should be reached just like that. You project it all the way minus 27. I wanted to, continue to push and swallow everything up here. So also I look for another entry in between, but the first trade would have to, take everything off. It's currently 10:21. We have 2% for the day. One thing to take notice is that once you take a trade, um, you should stick to your trading strategy and your risk reward ratio because that is what's going to determine it, right? If you keep fluctuating your risk reward ratio a lot, no more than no sorry less than the strategy calls for example 1 to 3 like I do, if you lower your risk reward ratio, it will mess everything up, right? You want to either higher it or just put it right there at 1 to 3. You don't want to lower your risk reward ratio because it will affect. First of all, once you lose 1%, right? The first thing it will affect is that your risk reward ratio is gonna go down. That means that you lose more than you actually earn from your risk reward ratio, from your RR ratio. Um, So that's one thing. The other thing is that it will mess up your stats. Your stats is going to be messed up, and so if you continues to if you continue to just trade and just exit and enter without reaching your initial risk reward ratio, what will happen is that your mixed rewards, right? You say, well, I trade 1 to 3 risk reward ratio. That's your maximum. That's your like median point. It's not even there as minimum. So trying to set your standard so that your risk reward ratio always at that level, like 1 to 3, like I do, or at 1 to 2, whatever that you want to set. I set it at 1 to 3, so I want to always meet that minimum 1 to 3 risk reward ratio, and or higher, like minimum 1 to 3 or higher. Don't even think of lowering your take profit. You know, um, so essentially, you want to stick to a standard. That's all I want to say. So here, after price come up, you can enter here on the price, which still yields a 1 to 4. When price come back down to minus 27, reaching this level here, it can melt down even lower. But the first trade, I would also always take 1 to 3. So essentially, it should be around there. Price come up, reach that, and then come back down. And interesting here is that we are scalping. We want to look for the best pie, the breast pie, the best price possible. So that's why you want to enter. It's a little bit more stressful than day trading and intraday because this is the setup, the projected trade for day trade, right? You can just enter here on projected trade and ride the price down. That's like an easier approach, and it's like a less stressful approach. But once you want to scalp, however, that means that you want to look for a really, really good area so that the spread and the commissions that you enter in the trade will be covered by the risk reward ratio. And of course, the potential has to be higher than the day trade projected trade. That's why I wanted to see this. So projected trade here at 1 to 7. And let's go down to 3. So what happens here is that when price come back up, and trace back down, I should have looked at this. Should have looked at this as buying pressure still coming in the market. You can see here price open bearish, price pushed down past the previous low. But what happens here? The buying pressure still pushes price up higher than the wick to the downside. This wick upside is basically indicating that buying pressure is still maintaining in the market before getting out. But we can see that it closed black candle. That means that selling pressure is entering the market as well. So that's one thing I need to notice more about it. That's signs of the candlesticks. Next candle closes, of course, an order block, a 3-minute order block. 5 minutes, nothing much. Let's go down to the 1 minute once again. So essentially, enter here. I got stopped out, and the trade has deemed a loss. Price come up here to a projected trade, and we can enter here as well. Essentially, when price come back down, I always want to look for a good retracement or even a potential of re-entry. As price going here, I want to still to look for a continuation bound. You don't have a 15 in any shape or form, so I don't want to continue pushing from just 5 minutes and 3 minutes. And as you can see here, when price come back up, wait for a sign, or you can enter here on projected trade. Price pushes down to this level here. I see this as a break of the previous low. This one here, this wick here, breakthrough, and then form a doji. So this is pretty significant. You form a doji here, and like I explained before, a doji basically meaning that price have been neutralized from both buyers and sellers. And you can see this doji is pretty balanced. And I would say this is a balanced doji. And one thing I can do is that because it is balanced out with that candle, that means that that's like the no man's land. When price come back and retrace that area, and in the trend of the macro or the trend of that lecture structure at that moment, it will usually reverse and continue pushing through because there are orders in that area because it is neutralized. So that's one thing that I need to keep in mind for. So essentially, after the doji form, it is extremely hard. I would say extremely hard for price. If it's like this balance, it's extremely hard for price to push past that area because, like I said, it is a desirable or this area here where people are still fighting back and forth. Not really no man's land is like the battlefield, and you want to look for this as the entry. So that's the interest zone after price broke through. So essentially, I was hesitate to enter. Shouldn't have hesitate and just continue enter here. a little bit sooner and press back up to the interest zone. So 1, 2, 3, 4.5, and then push price down once again to 1 to 3 risk reward ratio, and entering out. Either way, it's still 1 to 3, and we took out anyways of the first trade. Give me a second, I'll be back. All right, cool. We're back. So, like I was saying, up here, the interest zone is this doji. After the doji formed, we can just enter here. So 1 to 3, just like that. Or as I did here, I did enter a little bit later, which still, as price, pushed down. So let's go ahead and mark this as adjustable trade. 4.5. 1 second. 11. It's right there. Cool. So that's what it is. That said, let's see. It is 10:40 at the moment. We have price no 15-minute forming, just the micro time frame on the 5 minutes. Price come back up again to that level. Let's see if it's respecting the Fibonacci or not. No, it's not. Still, I want to see the Fibonacci retracement, a good level of retracement before I can go in. Again, that's like concepts of the strategy of concepts of something like a set of standards that I stick towards. That's all. You can just play trades around. It's not really that um, concrete, I would say. It's not really that uh, set in stone. You can just go ahead and take a trade right here. It doesn't matter as much, right? If it wins, it wins. If it doesn't, it doesn't. What matter is that if it once you predict the direction of the market, that's all you need. If I'm being honest with you, the direction of the market, the trend of the market, where you are, where the market's gonna go, and you predict where it's gonna go in the short term, um, you can just make money just like that. And if you can predict where it's gonna go in the long term, like this is just short and this is medium term, right? Mid-term where price can come back down, but long term, you don't know. Long term after this move, I'm not really that sure where it's gonna go. It can potentially push up once again, but long term in this is really hard to see. I can only see short term as price continue push down, right? And then medium term is that it gonna continue here, maybe swallowing up here, maybe a little bit of transitioning and price choppiness around here, but I cannot see a long term where price gonna continue pushing up or down. So here's the thing about long term wise, right? This is the long term, right? This is long term. Well, you can see price, obviously, price coming up. Let's go ahead and zoom out here for you can see. You can obviously see that price is trending upside. That's why, Fibonacci wise, you can sort of draw it from the lower time frame to, from the low to the high, and then you can predict where the direction of the market is going to go, and you can see that it matches pretty nice. That's where you predict the macro. That's a long-term trend, and that would ultimately make you good amount of money because you can predict the long-term trend of the market. But as scalpers and as day traders, we only care about we do care about macro time frames, that's for sure. But we care 80 to 90% about the short term and the midterm. Um, I would say around if just midterm and short term, I would say around 80% short term and 20% midterm. Midterm is just where the direction of the market is going for the day, or that session alone, and the short term is basically how how market transition and how the range works. This is short term, like extreme short term here. You can see how the range work, right? This is short term. It doesn't matter if price continue upside, downside or not. This is short term, and it has pushed through the previous low. Price come up and push through once again. So we're looking for a retracement. That's just kind of like the gist of it, right? You see the direction of the short term of the market, and you know where it's gonna go. Not really like guarantee. You are expecting where it's gonna go, and you're predicting the trend. And um, as you are getting better and better at predicting the trend, as you get better at just overall structure of the market, that's how you're gonna make money, right? You can counter trend. You can argue this is a counter trend. It is a counter trend, but at the same time, it transitioned. That's why we wait for a transition, and it's not so a counter trend. It's just a trend. It's not really that counter trend. It's counter the long term trend maybe, but in the short term, it is trending downside. It is trending down once again. So once this hits one of the major levels, it enters the midterm or the long-term trend, and you need to look for a transition on the short term, which is matching up the short-term trend with the midterm and the long term in order to continue. But counter trend, you can say that it is a counter trend because it counters the long term, it counters the midterm, and on short term wise, you can see here price is continuing down, broke to the previous low, and then continue pushing down once again. So as long as you predict where or just see where price is going to be in the next, of course, in the next few days, then it should be fine. Macro trend, that's the macro, right? And as day traders and scalpers, we're looking for a short-term trend of the market. Of course, it's going to be stressful, more stressful. You can say you could pop a trade anywhere in between, right? That's a good strategy as well. I don't mind that. Really good strategy. Yields more stabilized of a return in the long run, as well as on a professional, on like the a bigger capital wise. Right now I have lower capital and I'm starting low. That's why even up to a few million, I say I can still scalp the trades. But essentially, when it gets to a few, like to I would say 8 digits, 8 digits or so, I have to switch to a day trading approach. Um, I'll not really say 8 digits. I would just say around 2 million, 3 million, around that point, or 7 digits. I have to switch to slower of like a day trading approach. Um, yeah, 7 figures and above, you need to switch a little bit more on the day trading approach because your slippage or as well as the commission is going to be slapping in your face. Um, it's not really that great to just scalp at, at that level of capital, you know. You want to aim for long-term capital growth because you have long past the consumer, the medium consumer. As long as you have a 100,000, that's pretty much it. And you can still scalp, right? Your whole life you can still scalp. The thing is, if you want to grow your capital even higher, you must change your approach into day trading. Have to change your approach into how do I maintain this, right? How do I maintain that level and grow consistently? The bigger your capital growth, you need to trade and make the market and see the market in different light. Um, so yeah, right now we're scalping and we are understanding the algorithm of the machines, understanding the algorithm of the short-term time frame, and basically making money off of this. So as anybody trade and starting out, I would suggest you to learn to day trade first, right? In the macro concept of the 15, 30 minutes or 5 minutes, that's still a day trader kind of concept. This is scalper, even lower. So it's a lot harder. I'll say this is a lot harder, a lot harder than day trading, a lot harder than intraday or long term swing trading, right? And it's also harder than day trading, but essentially, day trading is a standard, right? It is a standard. Scalping is basically you are zooming down even lower to look for a better and harder entry. And sometimes it doesn't work out. Sometimes it gets stopped out, and sometimes it works out and you get a better risk ratio. And you can see here, this is a prime example of day trading versus scalping. As scalping, as a scalper, I will always want to look for a better entry of price, right? But you need to draw the line in between because that's why the first trade it doesn't matter as much. The first trade to me, I always want to take 1 or 3 risk ratio. The other trades after the first trade has closed, right? The first trade closed at 1 to 3. I look for another trade, in which case now I'm going to be lose. I'm not going to like take at 1 or 3 and that's it, right? I'm gonna take my profit at 1 to 3, set my stop loss at 1 to 3. If it passes through or not, I can set my stop loss a little bit higher than the 1 to 3 mark, and then if it comes up and stop me out, it's fine. I still get profit. It's an extra profit. But if it comes down and lower the take profit, even through 1 to 4, 1 to 5, I will take profit along the way. So it's like a bonus. So that's like a scalping, a standard for me to uphold to. But that's essentially what's about the market. Scalping is just a zooming down. It's just a more micro, one more layer down of day trading. And I would not suggest you to go tick scalping. Tick scalping is probably not sustainable. That's never sustainable and it will never be. Scalping is, I would say, the level where it requires the most experience, the most stress out of all the other trading time frame. I would say scalping you need to require much more studying and how to see after day trading, and you can see all the macro time frame, right? At 5 minutes, how it transition and stuff. Once you zoom down even lower, this is 15 minutes, right? This is 15 minutes right here, right? We can see, oh, price retrace 15 minute, cool. All right, go down to the 5 minutes, right at five, price retrace 5 minute, cool. Once you zoom down to 3 minutes and especially 1 minute, things get a little bit, more confusing. But like I said, day trading is the standard of the industry. It is standard of day trading. It's called day trading. So people naturally going to gravitate towards day trading and essentially go from 5 minutes order block or 5 minute time frame or higher. Very few, select few, go down to the 1 and 3. I go down to 1 and 3. Maybe people go down to 1 and 3 as well, but it's not really that much, right? As scalpers, we want to look for a better entry price, a better stop loss, and a better risk ratio. But the first trade here doesn't matter as much. I need to draw the line, and I think in the future I need to draw the line as well. Um, so I don't need to, look for unnecessary scalping position without, yeah, and I don't want to look for unnecessary scalping position if I don't have to. So essentially, look for signs as well. So on the 5 minutes, you can see, oh, this is it. Price come up, sure. It comes up here, then it basically around. You can enter here. That's pretty much it. And you test your strategy over, say, historical data, right? Once you go down into a lower time frame on the 1 minute, you can see a lot more. And this is what's going to change a little bit more about your approach and the signs, and you can prevent a lot of losses as well as stop losses um, in this manner. So you can see on the 1 minute here, price come up to this level, sharply pushed down. You can see here it is a clean graveyard candlestick. You can see price push it up, and this is a lot of sell pressure, sell side liquidity. Boom, just go ahead, and this is a 1 to 10, even more 1 to 15 ratio of the candle, right? And you can see price pushes through. This is a sign for you to enter, but you can see here on the second um, 1 minute candle, price still maintaining that pressure, and so that's a sign of price transitioning and pushing down. So that's just basically how you refine your entry in within that level. That's all it is. And so, like I said, I'm waiting for the 15-minute time frame order block, but there isn't anything here. Um, say 5 minutes there, price come up once again to the 5 minutes. This one is a doji. Like I said, doji is one of the areas you need to look out for because it is one of the battlefield, um, indicating neutralization. And essentially, price come back up here once again for my doji. And this is just another area where we can enter in. So I have to be a lot more lax in terms of trading because if you are setting your rules and you stick into it all the time, I guarantee you all of the other guys that you can see online, all the in social media, all the YouTube videos that you see, they teach you, right? They educate you as well as this stream here, as well as what I'm saying now. It educates you in how to see the market in different way, different light, from different perspective because it is extremely subjective, just like any market in the world, right? The real estate market is subjective. One person can look at this house and say, "Well, that's not a good investment. That's not a good house, and I shouldn't really fix that up. It costs a lot." But one person will see as a treasure, right? They will go in, they'll buy in, and then they will fix up the place, and then they will see it as some kind of flipping strategies, flipping um, opportunity. So they grab every opportunity they have and not considering too much about the rules, right? And those people are going to, of course, get the rewards that they deserve, which is catching the opportunity. So I would say lose your lax up your strategy a little bit. It's not really about the strategy. It's about your understanding of the trend, your understanding of the market, and yeah, essentially that's the same way for Fibonacci or all the order blocks. I would say the order blocks is people understanding on the surface level. They will say, "Oh, is it order block?" Right? They explain it is that when price come up to the level, there are some, for example, bullish like this market right here, right? Price come up, cool, right? So it formed, let's say, an order block here. Boom, boom. Let's say fire price form this as the area. Let's continue down. There. So let's just not draw the wick at the moment, but essentially, you know what? Let's just draw the wick so it is a lot more easier to imagine. And there we go. So essentially, when price come up, right? It formed this order block over here, and it continue up. So explaining on the surface level is that the buying pressure coming in, buying orders coming in, and then when it's this level, price pushes down. Once at this level, there are sell orders pushing down, and then when price back come back up again, it stop a lot of all sell orders out. So people are going to either get stopped out or they holding on to the position in this area here. So when price trying to return, they exit out, right? They exit out their position. That means that the selling orders are going to come off, right? The selling order is going to basically evaporate. Most of them it come back up to this area here, so people are going to stop at break even, right? Other than a loss, if they are going long in a swing long term trade, so come down here, they get out of their position. That means they return the liquidity, returning the liquidity as well as increasing the price. Since they are selling on the currency pair, that means they're buying in. Essentially, they're buying in from this level over here. So look, the liquidity returns into the market, right? All the selling orders here, right? Most of them are going to break even and they're going to buy in the market because they sell here. They are going to counter balance, balancing out and buying the market, either exit out their position by basically exiting out and buying in the market. It causes the price to push up a little bit, right? You can see sometimes that the trend does it because sell orders are here, and it signifies that by order blocks. And you can see even zooming out to the second time frames as well. The second time frames, as of course, are going to see a lot of shit, but I don't want to use the second time frame. It's just not popular and it's not really that great. So price come down here. Like I said, people break even and they exit out of their position. That means that sell orders are going to buy in. They buy in, causes the price to push up. Now, if it is a really good level, and it signifies something else, right? Because this is a sell orders, right? Selling position, meaning that sell orders are signifying this level. So if it breaks through, people are still gonna hold, or people are going to start to enter in once again. They get stopped out at break even, and after price break through, that means, right? There are two scenarios. One, price come down and broke through this selling or this sell order block over here, which we call it. Price come through, people are going to get stopped out break even, right? And they're going to re-enter in because they now know that price have not respect this order block, respect the level of price not bouncing up, so it has power to push through after getting break even, or they hold on to the price, right? Break even, they buy in, and then after price broke through the low, they sell again. So that causes the price to push through and pushing through. So this is the area of mid level where, let me mark this up as red. This is the area of mid level. So this is the thing you see over and over in the market, is that people coming down, people price or position coming down here and breaking even. It breaks even, right? People are either going to get out of the position, they buy in the market, causes the price to fluctuate a little bit. That's why you see resistance, right? That's why you see resistance on the one side. I will go to the other side in a little bit. But that's one side of the resistance, they're getting out of the position. So option one is either price going to push through that level, price going to push through the level. So price basically at this level here, going to push through, meaning they're going to re-enter. That means that that level was not respected. It's pushed through, and so they can get in profit once again, right? People are going to hold or not. So when price come back up here and retrace the previous support level, which is the support and the resistance strategy, right? It comes back up here once again into this level to the left. So people are already stopping out and getting out the position, are going to re-enter at this support turn resistance level. That's now a resistance level. And now people are going to re-enter here. And what you see on the candlestick chart on the order blocks is just that at this level right here, let me just draw this, finish this. At this level right here, there are a mix of people getting out as well as people getting in and trying to respect this order block here and not trying to push price through. So this order blocks in between the level, right, is acting at a resistance. So again goes for the micro time frame over here. The same things go, right? The same things go here. This is the macro time frame. The same things go here for the micro time frame on the 1 minute, 3 minute, 5 minutes, right? It goes the same thing over here. So you can see all the blocks coming back and forth, back and forth. And price broke through, and essentially price coming up here once again. People want to maintain that level, and this kind of like revert the reverse of this. And so when price coming up here, it either have an order block that confluence it, or it does not have a order block, and it is just a support or resistance zone, which basically left the level, people getting out of the break even, and now not really people, maybe machines. A lot of them are machines, but when price coming up to this level here, people are going to enter, re-enter in. Sellers are going to enter in the market once again, and then push its price through. So that's one thing. The other side of the market is that it's not now no more sellers, buyers. For example, you say you have bought in this level instead of selling here, right? Either you buy in here early and price push up in your direction, take profit and such. When price come back down here, what usually happens is that you have taken most of your profit out, right? You have in profit, so either you're going to take out of your old profit and you're going to sell it. That causes the mix in between. The mix, people are or the machines coming here and the profit have already been reached. They enter in early in this resistance, right? Even after it, even before it was formed, selling orders pushes price up and taking profit along the way. When price come back down to this level, um, they get out of the position, right? Because they now, as buying orders, they are going to sell because okay, why not, right? They already because that is one another side of the market is going to be less power. It's going to have less power than normal, right? It's going to have less power than the sellers get exiting out
or the buyers buying in from this level. That's another, and going to go over it in a little bit. But now buying orders from this push upside, taking profit along the way, for example. So when price come back down here, they can break even, or if it, even if they still have an order, right? Even your take the take profit has not been reached, or they take profit along the way. Either way, when it comes back down here, price come back dangerously close to their entry price, they're going to sell and just neutralize out their position in the market, or they have reached take profit along the way, come down here, and they still have some loss size available, they still sell. So that's compounds in together, right? That's one side that that the machine or people's buying in here early, getting in. Either their take profit was not reached, or they take profit along the way. Either way, when they come back down here and they still have some lot size or volume available, they're going to sell because it's dangerously close to the stop loss and coming back down to neutralization, and they don't want to see a loss, right? They don't want to see a loss, or they hope for a price to push up again and again. They basically the same side here. Some people want to hold, and a lot want to exit out their break even position, so they're not trapped and coming into loss. And the final and the trend moving in basically the strategy wise of the market, price pushes up like that. Now, as sellers and as retail and as how I trade, I see this order block. Like I explained all the previous points before. If I come back out here, I look for a buy. The reason why I look for a buy here is that this is more or less a neutralization level. If it is matching up with the Fibonacci, historically Fibonacci has been proven to work. Every single pair, every single strategy works with the Fibonacci, and I would recommend if you're not using the Fib, you have to use the Fib because it max up the zero point 0.5. That's the main thing about it. The zero point 0.5 is a discounted price, or institutions or people or machines deem as a worthy level of discounted price, right? Where price is not that expensive, it's not overbought, oversold, it's not too overpriced. In terms of it, they say that for fancy reasons, but in actual trading term, it doesn't give a shit. It doesn't really matter, right? It doesn't matter at all. In terms of good price or discounted price, those things are just fancy terms. That's the algorithm. That's just the algorithm of the market and how it works. Because zero point 0.5 or lower, that's like the equilibrium. When price coming back down to neutralization, like I said over here, it's just another fancy term, another fancy way of describing the order blocks here. It's just another fancy way of describing all the orders, the hidden orders that has been in the middle. And historically, I can't speak English, shit. And historically, it has proven to work at zero point 0.5 or lower premium point because um, it's not really proven to work. It's just that that's the optimal zone where you can have less risk, less space for you to make errors, right? And it has a higher probability to basically retrace and transition because that's a neutralization area. Even if it doesn't have an order block to the left, it still signifies the hidden selling, hidden buying orders into the left of people are going to buy in and sell in. So it still signifies the hidden areas, as well as it signifies the new area that people are going to sell in. Just like how natural things work, right? Outside of the market, no, sorry, outside of the forex market or any financial market, you go to the supermarket the same way. It's like buy one get one for 50%, 50% off. That's like the psychological level. That's a psychological price. That's a psychological percentage. The reason why it works is just psychological, and it's based off of human psychology. If we all act as machine, if every machine is not based off of human, based off of aliens or some other worldly creature that had made and have the power, everything will be chaos. There's a reason why the system is in place and you can make money from it. It's just there is a system. The machines are made by humans. Okay? Machines are made by humans. The algorithm is made by humans. The machines you see making the market is made by humans. It's not other aliens or other worldly creatures. It's made by humans, and it essentially reflects how the market and how the human works. Even though they're machines, for example, AI the same way. AI learns around the world, but because we are their creator, they're going to learn from us, and the values and the things that we uphold may not be that great. So they're going to learn. The machine the same way. We humans create programs and machines based off of our psychology, based off of our experience. That's why the market makes the same way. You can argue that, but essentially that's just all psychological, right? A lot of points are going to be made in this video here. So this is a really important video about psychology and market structure, how the market actually works behind the candles, and how it's basically moves. The fundamental you need to understand about the market, understand about how the candlestick form, how the candlestick and how the structure of transitions, how the structure of how the market essentially move in a like a structure. I don't want to. I want to know what I'm fucking saying anymore. Um, yeah, I may be a little bit bad in explaining it. I may be a little bad explaining it because um, my English is not that great. But I hope you understand. That's all I want to say. But yeah, the same last thing here before I end the stream. So the third area is that people here, like me, going to look for people have not have a position beforehand, right? They have not entered in anywhere beforehand. Now they're going to look for a buying opportunity or a selling opportunity. So as this is the market making right here, the position the positions before is making the market. So people are going to get out. That's the one side. The other side is that when price is trending downwards, price is trending downwards in order to retrace, right? Candlesticks are forming downside in order to retrace. That means that the short-term trend is bearish in this example. That means that short-term price is bearish. Okay, that's why you need to look for a good transition, a good sign of rejection. That's why there is right there. That's why there is this one right here on the 1 minute that I draw through. Right there is this graveyard indicating that price selling pressure, selling liquidity is coming in the market. Right. The same goes for this level. Right. Look for signs. Look for transitions, and essentially you enter here as a second person, right, to higher your chance of getting into a good price. So you're not like a second hand. People here either going to hold or get out, right? You're going to have here, this is the initial price push, and this doesn't have that much power. What have power is that the trending market downside, right, when it's come back down to retrace, this is essentially a candlesticks, for example, right here. You can see on the 15 minutes here. Price coming down here. This 15 minute is this trending downside. It is trending down. And you can see on the lower time frame, it's slowly slow down, it slow down and slow down and transition up again. This happens. Sometimes it doesn't. Um, but most of the time it will slow down and it will give time for the buying liquidity to come in the market. So as traders, we are looking for transitions and signs of buy side liquidity in this case, or sell side liquidity. In this case, it's buy side liquidity to come in the market, rejections, candlesticks, whatever it is that you're going to learn. But yeah, this is the fundamental of the market and how it's actually moves around the how rejection moves, how bounces move on the Fibonacci and such. All psychological, all psychological. Like I say, is the reason why price exit and enter all psychological. That's why the short term trend is downside. That means that it has a better chance of pushing through other than retracing around here, right? So that's why I just look for a transition and have some signs just like this one here, a transition before we can buy in and ride the price up, because the macro trend is still relatively high. The macro trend is again on the other side, macro trend is high, just like that. So when price come back down, it's still going to continue up. That's the fundamental behind the price, right? So the short term trend downside, but the macro trend wins over because it is of course it's going to be bigger, right? The trend, all the selling, sorry, all the buying orders, all the buy side liquidity is going to be larger than the sell side. That's why it's come back down to equilibrium, and the psychology behind it, I just explained it to you, right? And that's why macro time frames wins over because essentially the trend is bigger than and more grand than the short term trend. So that's why it wins over. But we cannot neglect the ability of the short term trend where it can push through. We don't know where price is ultimately gonna go. It's just that we are predicting, and the trend, the instinct of us is basically to wait for price to come down into this level and then pushing up because that's basically how structure works, right? But again, like I said, there's no guarantee it's gonna bounce. It's just that we predict and we're going to see it like that. If it happens to have a transition here, we're going to enter it. We're going to enter a position, a trade in here. But essentially, that's all I'm going to say. And that's pretty much it for today's stream. That's a lot of information if you guys are new. And even a veteran, like even a midterm trader, a lot of these concepts, a lot of the reason why, I just asked why price pushes like that. And it just happens so that, I can find an answer into it. And yeah, it happens so that I can find an answer um, so clearly like this, so I can explain to others of how the market actually moves instead of just wow Fibonacci psychological and all the order blocks and such, right? Without going into depths of why market moves that way. This is just a in-depth explanation or the description on the facts of the market. It doesn't change the way the market moves. It doesn't change the way you trade, right? It just open up your perspective. It's just opening up your mind and perspective when you look on the charts and you see on your back test and you see it when price coming back down again. Just to explain to you how the market basically moves in the psychological way and how position enter in and exit instead of just price can make to that order block level I should look for a transition, right? Instead of just that, now you know that price going back down to that order block area, the reason why you look to a forward transition, the reason why. So this just explaining why market moves certain ways, um, why the things move the way they do, and essentially that's the thing that I wanted to get out there. This is the reason why. Always stay curious, ask why, and once you figure out the reason, it's much more clear, right? Now I don't need to ask why anymore because I get to the roots of the issue, right? Um, the reason, like again, I asked why price moving like this. It's dirty, it's floating, right? Because price is floating, because there's open volume. Institutions and banks can manipulate the market. That's just the way it is. Can't really change anything about it. But yeah, I've reached the point, the roots of the issue, the roots of the why. So now I see in like an open perspective of how the market's gonna move. Doesn't change really. Doesn't change much of your strategy. Doesn't change the way you approach the market. Um, but yeah, essentially that's pretty much it for today. Nothing else coming into the market. Nothing else really. It. But yeah, that's pretty much it. It's 11:17 at the moment, and we have the 15-minute doji here. Maybe reaching up over there. Maybe continuing. Maybe downside. Doesn't matter as much. We already out the market. But yeah. So today recap. Let's go ahead and close the chart and close it and call it a day. Going down to FTMO. So today we have again made the trade from that. I didn't really say anything around there, but essentially we made good profit from that trade. So 1 to 3, 1 to 3 commission minus is exactly 1 to 3, basically. And then we lose the first trade here. Our stop loss basically I didn't really set a stop loss. It's just mental stop loss. After it broke through, it broke too high, and so it going after 150 of it. But essentially, it's basically adding up to this loss here where I closed early. So overall, we are at that level. We're approaching the profit level of 2,500. That is the profit target that FTMO have set out. I'll go to the dashboards as well. I have another 2 days, I believe, Yeah, I have Wednesday and Thursday to reach that, and essentially it is at 51 or at 52. I'll say at 52,000. And yeah, that's pretty much it for today. And with that being said, I'll see you tomorrow on Wednesday, and let's just get it.